In this lesson, we're going to identify the 4 different types of orders and introduce some fundamental terms and tools you need to know in order to understand the way orders work. Institutions and retail traders can only do 2 things. They can buy or they can sell. However, by combining different types of orders, investors can go long and make money when markets go up, or go short and make money when markets move down. There are 4 basic order types: a market order, a limit order, a stop market order, and a stop limit order. Each of these order types have important details that you do not want to overlook. In upcoming lessons, we'll be focusing on each order type, but first we'll go over how orders work. There are 3 key terms we need to know. The first is the bid. The bid represents willing buyers in the marketplace. The buyers are using limit orders, which is an order to buy at a specific price. Next is the ask, which is often referred to as the offer. The ask represents sellers in the marketplace. These sellers are likewise using limit orders to sell at a specific price. Finally, we have the spread, and the spread is the difference between the bid and the ask. To help make these concepts clear, we'll go over an example. The illustration here is referred to as level 2 or market depth. It is data that groups limit orders by the price. The bid side of the grid on the left represents limit orders for investors willing to buy. The ask side of the grid on the right represents people willing to sell with limit orders set at a specific price. The top row of the table on either side is referred to as the inside bid, which shows a bid of $30.26. This means that somebody wants to purchase shares at that price. These are considered passive buyers. In the next column, you can see size. Size means that the very same person wants to buy 100 shares at that price, $30.26. Right below on the next line, there's someone else who's willing to pay 1 penny less at $30.25, and they want 50 shares. The best price that someone is willing to pay with a limit order will always be at the top of the grid. On the ask side, the top level is called the inside ask and represents passive sellers. This is also the lowest price that someone is willing to sell their shares at. In this example, we see 4 offers to sell shares at $30.42. In the size column, there are various quantities of shares available to buy at that price: 100, 11, 300, and 100 shares. Below that, there are 2 people willing to sell 100 shares each for 1 penny more at $30.43. The difference between the bid and the ask is called the spread. As you can see here, the bid price is $30.26 and the ask is $30.42, which gives you a 16-cent spread on this specific security. Now, on current markets, spreads are usually between 1 and 2 cents. A 16-cent spread would be a red flag for risk. Here are 3 more terms that we need to know. When a trade order meets its entry price and the trade becomes live in the market, it's called an execution. A filled order is when an order is completed. When you receive the shares that you bought, the order is filled. It works the same way if you decide to sell something. Once all of your shares are sold, it is considered a filled order. Now, depending on the security you're trading, slippage may occur. Slippage is simply the difference between the quoted price at the time the order is sent and the price when the trade actually executes. In a nutshell, it means you didn't get the price that you wanted. This happens to securities that are thinly traded and don't have a lot of volume. So now you know what the 4 types of orders are, and you're familiar with some of the basic order terminology and principles. As we progress, we'll dive deeper into when and where to use each order type. Before you move on, memorize and understand the difference between the bid price, the ask price, and the spread. Memorize and understand the difference between the terms execution, filled, and slippage, and understand the difference between the passive orders, a limit bid and a limit ask, versus aggressive orders such as a market buy or market sell. Hope to see you in the next video.